Good evening and welcome to another episode of Night Markets. Financial markets close at 5 p.m. and night markets open at 6 to widen the conversation. Each week I'll be giving you my perspective on what's driving markets as well as my point of view as a family office professional. My name is Jacobus Brink, the Chief Investment Officer and Head of Investment Research at SFO. So during the week, global markets remained influenced by regional developments, economic data and monetary policy signals, with bond yields rising and equities showing mixed performance across the various regions. These dynamics reflect ongoing uncertainty, particularly as markets weigh inflation risks, central bank decisions, as well as geopolitical tensions. So before we get into markets and macro, let's just check in on the current situation in the Middle East. So during the week, the conflict between Israel and Iran intensified, with Israel targeting Hezbollah in southern Lebanon after an Iranian missile strike. Concerns are growing over a prolonged conflict, particularly as diplomatic avenues remain blocked. The conflict threatens to spill over with potential global ramifications, especially for energy markets, given the region's strategic importance across the globe. Global oil prices rose slightly, reflecting market concerns over potential disruptions to supply, while defense-related stocks gained as tensions escalated. So moving across to markets and macro, starting in the US, US markets hit new all-time highs as earnings season started fairly strong. We saw some releases from major banks like JP Morgan and Wells Fargo, exceeding expectations, which lifted sentiment in general. Growth stocks outperformed, led by Nvidia, while Alphabet faced some pressures from regulatory concerns. Inflation data out of the US also showed a moderate rise, tempering hopes for aggressive federal rate cuts later in the year. As the US presidential race tightens between Vice President Kamala Harris and Donald Trump, markets are watching closely for potential shifts in fiscal policy going forward. So just looking at the markets, the S&P 500 closed higher by 1.15%, with the Dow Jones and the Nasdaq both closing higher by 1.25%. US Treasury yields also climbed, with the 10-year yield hitting 4.12%, reflecting concerns over inflation and labour market weaknesses. And then moving across the Atlantic to the Eurozone and the UK, European markets showed some modest gains as the Stoxx 600 index rose on the back of expectations for the European Central Bank to cut rates further. However, Germany's economic outlook remains troubled, with a sharp decline in factory orders signaling continued weakness in the sector. In the UK, GDP grew by 0.2% in August, driven by manufacturing as well as construction, but the Bank of England remains cautious, balancing inflationary pressures and wage growth. Looking at the market performances in local currency terms, the Stoxx Europe 600 index rose by 0.66%, while Germany's DAX also gained 1.32%. The UK's FTSE 100, however, fell 0.33% during the week. And then moving further east to the Asia-Pacific markets, Japanese markets ended the week higher, with the Nikkei 225 up by 2.45%, benefiting from a weaker yen that boosted exporters. On the monetary policy front, rising exports, declining wages and household spending signaled ongoing challenges, keeping the Bank of Japan in a holding pattern for now. And then moving further south, in China, the momentum from the stimulus measures seemed to have faded over the week, with weak consumer spending during the National Day holiday, and falling markets as the Shanghai Composite dropped by 3.56% and the Hang Seng Index also declined by 6.53%. So moving back home, South African markets experienced a fairly mixed week. The country reported a trade surplus of 5.6 billion rand, but both exports and imports declined on a year-over-year basis, reflecting broader global economic challenges. The rand initially strengthened due to the US inflation data, but weakened by the end of the week as stronger US jobs data bolstered the dollar. And then just looking at the markets, the all-share index ended the week down by 0.21%, with the financial sector actually gaining 1.5%. The rand traded at 70.42 against the US dollar by the week's close, reflecting ongoing currency volatility. And then just looking at the week ahead, investors will be focused on US retail sales data out on Friday, a key indicator for the health of the economy, as well as possible future Federal Reserve policy decisions. In the Eurozone, we'll also see the release of inflation data that will be closely watched as the ECB considers further rate cuts. In China, the focus will be on third quarter GDP data as well as industrial production data, and these will be critical in assessing whether the recent stimulus measures are helping to revive the economy. The market will also be focused on major earnings reports out from the US, from companies including the likes of Bank of America, Netflix, and Tesla, which could also further provide insights into the broader economic trends in the country. Any surprises we see in the US retail sales or Eurozone inflation could, however, trigger shifts in monetary policy expectations going forward, which could affect bond yields and equity markets globally. On the local front, South Africa's CPI data release on Friday will be a key focus for the Reserve Bank's future interest rate decisions. And then, as always, we'd like to end off with an interesting investment idea we discussed during the week. So the percentage of US states with rising unemployment claims has risen back above 20% on a year-over-year basis. This has often served as a good recessionary signal in the past. With the latest initial jobless claims jumping to the highest numbers since the pandemic, it shows that more than hurricanes are currently impacting the labor market in the States. A negative 10-2 spread has predicted every recession from 1955 to date, but has occurred with a 6 to 24 month lag. The Fed, however, tends to focus on the 10-year to 3-month spread, which is still inverted, but is trending positively at the fastest pace since the start of 2023. The recessions often predicted by a yield curve's inversion typically don't start until after the inversion is unwound. So in other words, the current yield curve moves coupled with the potential weakening in the labor market might suggest that now is a good time to start thinking about playing a little defense in your portfolio. Thank you for joining me on another episode of Night Markets. Financial markets close at 5 p.m. Night markets open at 6 to widen the conversation.